now we have the fun of talking about the consumer and the consumer in general. And one of the fun pieces is the consumer sentiment indexes. So there's two key ones. There's the Conference Board, and then there's the University of Michigan. And you can see that there's been a fairly broad divergence over the last, essentially 2 years at this point. And it's just a matter of who you're speaking to, who's responding, and how is it being extrapolated. And one of the things that we've said is that neither are right, and there's probably somewhere in the middle. But even still, when you take them separately, they're each showing that they're fairly low for where they tip, or they're at a point that typically signifies a recession. So just looking at the Conference Board consumer expectations, current conditions at this level, we've very rarely been at these points without seeing some sort of recessionary backdrop. And that, I think, is an important piece when you look at the underlying fundamental failures. So then when you take this to the next level and say, okay, well, how are people's spending habits changing? And I thought this was an interesting one because the civic science guys, they do some, I think they come up with some really good questions that kind of cut to the point. Some of them are a bit, roundabout, but I thought this was a good one. In the last month, have you stopped yourself from purchasing something at the grocery store because of its price being higher than usual? And look at the yes many times and yes a few times. Only 19%, or is that 20%? Yeah, about 20% said no, not at all. That means that 80% of the people said either yes many times or yes a few times. Now, I don't know if you have gone shopping for your Easter gifts for your kids or for the candy, but the package is smaller and it costs more. So again, shrinkflation, inflation, there is a lot where people are now picking something up. And honestly, I can't see it, but I'd like you to honestly ask yourself how many times you've been in a store, you've picked up an item that you have bought God knows how many times, you picked it up and you went and you looked at it kind of curiously and then moved your hand up and down to see. It's like, oh my God, is this, did I pick up the right thing? Does this weigh what it's supposed to? And it's funny because mentally, there have been a couple of times where my wife asked me to go pick up, my kid's favorite cereal, and I've picked it up and then I look at it to see if is it broken? Like did half of the contents fall out somewhere? Is this a damaged box? Because you're like, there's no way this is a full box based on what the weight of it is. So then you take that to the next level and say, okay, well, how are people going to react if there's a refund? Well, if you get a refund, how do you plan to use that money? Pay off debt is number one. Put in general savings account, 2. I don't know yet, which typically means that it's going to go to one of those other 2. Save it for a significant purchase like a car or a house. Buy something I've been wanting. So when you look at the shifts in general, 35% said pay off debt, 32% said put it in general savings account. So 67% of correspondents said they would put it away or pay down debt. That, I think, helps identify kind of the position that I think more and more people are finding themselves and why we remain cautious on what summer spend is going to look like. Retail inventories have climbed back to record highs while retail auto inventories are still climbing back towards their 2019 peak. Growth in the latter has been significant of late. The ratio of retail sales relative to inventories ticked down slightly in February and seems to be settling at a higher level. So when you look at inventories, this is why inventories are back to where they were, well above pre-COVID at this point, but also back to, and you're starting to see the seasonally adjusted retail inventories, and inventories are high. Why there's a good chance that you're going to start seeing some sales, people trying to move some product, because you're not seeing buying happen to the same degree, which then means people aren't going out and ordering more from China or some other place, which again slows down some of that underlying movements. Contribution to excess savings, fiscal support was obviously a big one, but reduction in outlays is not something that was there in the beginning, but now it's something that is becoming a much bigger piece to where things are, but it's been difficult because it's hard to reduce outlays when costs are going up so much. And that's why we see fiscal support's gone away. And then that reduction in outlays is very difficult, which again creates more and more problems. February wholesale inventories were up 0.2 month on month versus the estimate of negative 0.1. Retail inventories, again, was 0.8, strongest since August versus the estimate of 0.2. So again, you're seeing inventories build, which is indicative of, again, people not doing as much. But to be clear, there's also a buildup because for anybody that's gone to buy bathing suits for their children or looking at summer clothes for kids, this is when stores start to get summer clothing for sale. And that's, again, it's going to be important to see what that looks like. But based on the trucking data, the rail data, the shipping data, it's much lower, and we're already seeing builds in inventories, even though shipments are very much well below where we've been going back to 2016. So then when you look at personal consumption, and this is the important piece, with a ton of focus on the perceived strength of the consumer, and this is from Liz Ann Saunders, who, if you're not following her on Twitter, you're missing out. Fantastic follow, fantastic data. And a good way to chop up information. But with a ton of focus on perceived strength of consumers, it's worth pointing out that the inflation-adjusted consumption can rise at the start of a recession, which was indeed true in 2008, as real PCE kept expanding until the peak in May 2008, a couple of months after Bear Stearns. And again, because Bear Stearns, people believe that was the end. And then you started getting rumblings, and then obviously Lehman happened. So now when we look at, for March Consumer Confidence Index, special question asked about spending expectations over the next 6 months. Consumers plan to spend less on highly discretionary categories, playing lotto, amusement parks, movies, personal lodging. Now, that is not the sign of people that are going out to go on vacation. And that's why when we look at things that over the next 6 months, so we're in March 30th, so that's April, May, June, July, August, September. So essentially during peak travel periods, the consumer is saying that they're going to spend less on highly discretionary categories of amusement parks, movies, lodging. That doesn't strike me as a comforting level that you're going to see someone going out and getting this big increase in just summer travel. And this is, again, another key reason on how we think the consumer has shifted, and you're going to get some of this weakness as we go into next month, the next spring and summer activity. Now, when we look at S&P, the PMI, so global March U.S. composite moved to 53.3 versus 49.5, and which was 50.1 prior. Manufacturing PMI, nice bounce from 47, an estimate of 47 to 49.3, and services up from 50.3 to 53.8. Again, very good number, good backdrop. So, but the thing is, and this is where the devil's in the details, is the upturn is a bit uneven because it's being driven largely by the service sector, which is, again, a big piece to the consumer. But as the service sector stays strong, it means that prices can stay elevated, and 70% of services is the economy. And that means that 70% of the economy can keep prices higher, which then keeps core inflation higher, because service inflation is sticky, while manufacturing and goods, it can fluctuate a bit faster. So when you look at manufacturing, which eked out a small gain, that was mainly a reflection of improved supply chains, allowing firms to fulfill backlogs and orders that have accumulated. New orders have now fallen for 6 straight months in manufacturing, again, a leading indicator. And unless demand improves, there seems little scope for production growth to be sustained. Services obviously had their encouraging signs. It'll be important to assess the resilience of this demand in the face of the recent tightening of interest rates and the uncertainty. Because remember, SVB just started this, the banking issue started in this month. So where is this going to go? And I think April is going to be a really good tell of people are behind or are past it and they're looking past, or is it going to adjust some of these movements? And then there's also that concern about inflation because the survey's gauge of selling prices increasing at a faster rate in March despite lower cost feeding through the manufacturing sector. So service costs actually accelerated again in March. Not a good thing for the CPI, not a good thing for the Fed or people who think the Fed's going to cut rates. February durable good orders came in at -1% versus the estimate of positive +2. Orders ex transports came in at 0% versus the estimate of 0.2. So again, you're starting to see that slowdown, but it's gradual. It's not like it's a dropping off of a cliff, which is what we've been talking about. March Consumer Confidence Index, when you look at it, came in at 104.2 versus the estimate of 101. Present situation moved down from 153 to 151.1. Expectations moved to 73. So again, you're just kind of waffling back and forth without any real direction based on kind of where we are here. Now, when we go to the next level of percentage of consumers expecting worse business conditions in the next 6 months fell in March to the lowest level since September 2021. Now, you might think, well, how? And the reason why is because the when this number is taken, it was prior to SVB. So I think that's going to be an interesting one to see how it comes in for next month. Jobs plentiful component within the Consumer Confidence Index ticked down in March. But again, as you can see, even though it came down, you're still at some of the highest levels that we've been at, which suggests a tight labor market, which is, again, going to give pause to the underlying Fed. Capital goods orders and then real capital goods orders, you get an idea of once you adjust for inflation, you've seen a movement down and a movement and a pressure point in that regard, which I think is going to continue. Huge divergence forming between new orders and employment components. And that's, I think, going to be a big piece because the Kansas City index fell to -13 in March, while the latter jumped to +18. So which one is going to be correct? Which one is going to see some of those different movements? And I think that's going to be an important piece going forward to see where that shakes out. Now, manufacturing for the Dallas Manufacturing Index came in at -15.7 versus the estimate of -10. New orders and shipments fell further into contraction. Production popped back up to an expansion. But, so you're seeing some of the different pieces, but overall came down. But the key piece, the leading indicator piece, new orders fell once again. Now, when we look at Richmond prices paid component manufacturing index continued to fall in March, emphasizing that maximum inflation supply chain are in the past. But even though it fell, going back to 2000, you can see we're still at the highest rate from 2000 till 2020. So yes, 21, 22, much higher, but it's just important to put it into context. Fed manufacturing for Richmond came in at -5 versus the estimate of -10. New orders improved, still contracting, but not as bad. And again, as we said, once you get to a point, we think they're going to contract, but more of a sideways move than a continuous down cycle, which is going to be an important piece going forward. Still in contraction, but not as bad in contraction, but still showing kind of what we've been talking about with an economic softness. Now, when we go to, let's see, that was, I just got, yep. So now that we looked, prices paid component for the Dallas Fed manufacturing fell in March to the lowest since 2020. That is more normal versus what has been previous versus Richmond, which is still elevated. But keep an eye on within regional Fed indexes, the outlook for new orders for Dallas Fed component moved lower in March and continues to contract, which again, means more subdued demand. And that's what we continue to see on that leading indicator. They're still deeply in contraction. So now when we look at underlying investors, most bearish real estate since October 2020, that is something that I think will likely continue at this point in time, just given where we are on the real estate sector. Home prices are reversing lower at a rapid rate. 3-month annualized percent change in S&P CoreLogix came in at 5.2% in January. Going back a few decades, that rate has only been seen during and right after the great financial crisis. January S&P CoreLogic index came in at 3.79% year on year versus the prior of 5.63%. So you're getting an idea that there is a contraction, but it's still early stages. I mean, look at this one on the left here. when you look, you're starting to see it just kind of roll over a bit, but the moves and the relative change is sizable. And we think it's just going to continue to now bounce around in contraction. So it's not going to be this whoosh to the downside where there's going to be this collapse. It's going to be kind of a gradual move, but it's going to be in contraction. And we just think that's going to accelerate. Now, taking a shorter term look at new single family home prices, 6-month annualized change in median price has bounced back up to negative 0.95%, which is an improvement from the negative 20.5% in Jan. As we've said, nothing dies in a straight line. It's going to bounce up, but the trend is specific. The trend is going to be to the downside. It's just nothing goes down in a straight line. You still have spring is more activities. You're going to get more people moving around, more people bouncing around. So you'll get more of that activity, but it's still going to be at a muted level. Now, when we look at January housing price index came in at 0.2 versus the estimate of negative 0.3. But you can see just the premiums where you're going to have some spits and starts in terms of where we are, but the trend, as we've been saying, is still to the downside because when we look at MBA purchase index, so we should see an increase. Pending home sales index should go up. This is a seasonal business. There's more homes that are sold in spring and summer than any other period. So it should happen. The question is, where is it right now? And when you look at the MBA purchase index, you can see that on a mortgage basis, it's still on the low end. And that's when you lay it over. MBA purchase applications adjusted, pending home sales. You can see that MBA applications are indicating purchase prices coming down and less purchases in general. And then change in national rent index, rent is going slightly back up. And it's just, you're going to have this back and forth until you get a lot of that supply coming on. Because remember, we're at a record amount of new builds of 5+ more units. So then when we round it out with February pending home sales coming in at 0.8 versus the estimate of -3, the level has seen a bit of a bounce. But again, you're bouncing off of a severe low. So that's where when you look at it in general, you're still at a level where you're just going to now go sideways. And that's going to be that bleed down that we've talked about with the monthly supply of new single family homes coming down to 8.2 months versus the recent peak of 10.1. But remember, nothing goes up and down in a straight line, and there's still a bit less supply until you get new builds coming on, until you get some of these additional pieces. That's what is going to take a bit more time before we see, I think, a bigger move down. But the Fed is very clear. They're not cutting rates. It's going to pull down asset prices, and housing will be one of them. So that's what we have for you in the US. In the next segment, we have Europe and some of the issues that are happening in that arena.